It seems like it's been an eternity, but the U.S. Treasury has finally released the guidance so many of us have been asking for, exactly which plug-in hybrids and full electric vehicles will still get the federal tax credit starting April 18th. That is when these rules go into place. So basically tomorrow, if you're watching this on April 17th. Here is the entire list. It's short, so I'll just read it out. We get the Cadillac Lyriq, the Blazer, the Bolt EUV, the Equinox, the Silverado, the Pacifica plug-in hybrid. You'll notice that some of those Chevys don't exist just yet. The Ford E-Transit, Escape plug-in hybrid, F-150 Lightning, Mustang Mach-E, Grand Cherokee and Wrangler plug-in hybrids, the Aviator and Corsair plug-in hybrids, the Model 3 Performance, Standard Range, and basically all versions of the Tesla Model Y. And that is it. You may have noticed that there are a few vehicles missing that qualified for the tax credit prior to April 18th, and that would be the BMW 3 Series and X5 plug-in hybrids, the Audi Q5 plug-in hybrid, the Volvo S60 plug-in hybrid, the Nissan Leaf, Genesis GV70, Volkswagen ID4, and the Rivian lineup. Apparently, those batteries do not meet the minimum requirements in order to continue getting the tax credit, but if you purchased one prior to April 18, you will still get the federal tax credit next time you file your taxes. And we'll talk a little bit more about the tax credit in just a moment. There are a few other things you should know about the vehicles on the approved list. At this point in time, the Aviator and the Pacifica are the only plug-in hybrids that will get the full $7,500 tax credit. If you get a Wrangler, a Corsair, Escape, or Grand Cherokee, you will get just 50% of the tax credit, $3,750, because of the way the tax credit is structured. On the EV side, the Model 3 Standard Range, not the big battery pack, but the Standard Range model, all versions of the Mach-E at the moment, and the Ford E-Transit will also only get half of the federal tax credit. With the Tesla Model 3, it's important to know that the Model 3 Performance will get the full credit. The Model 3 base version will get only half the credit. Let me digress for just one moment and say that there is one huge caveat to this list. We're talking about vehicle purchases here. If you lease an EV, then the landscape is quite different because a whole host of EVs and plug-in hybrids may or may not qualify for some portion of the credit. That's entirely up to the leasing company and the manufacturer and how their tax situation works. Remember that if you are leasing a vehicle, you're essentially renting it. The company that bought it is the finance company that is leasing it to you. And whether or not they get a tax credit for that leased vehicle and whether or not they pass that tax credit on to you is an entirely separate matter. And a decent number of EVs will still qualify for a leased credit after April 18th. So this is the list for EV purchases. If, like many luxury shoppers, you are leasing your EV, then check with the leasing company to see if they will still get the tax credit. That would include EVs that are not assembled in North America as well. As of the day that I'm recording this video, a key number of auto manufacturers don't pass along any sort of federal tax credit if you lease an EV, and that would include big players like Tesla, General Motors, and Ford. Kia also does not pass on a tax credit, but oddly enough, Hyundai does, so does Jaguar and Polestar and Volvo. Finance companies will apply the credit in different ways. Some may list it as an itemized cap cost reduction on your lease, whereas others may simply adjust the residual price of the vehicle. Now let's take a deeper dive into the tax credit. How does it work? What do you have to do to qualify? And what has to happen to keep these vehicles on the approved list? The most important thing to know about the IRS tax credit for EVs is that this is not a refundable credit like the child tax credit. I'll let you Google the difference between refundable and non-refundable if you want deep dives. But in a nutshell, you have to have a minimum tax liability for this credit to function. So with a child tax credit, if you don't owe any federal taxes, you'll still get money back from the government. With an EV tax credit, that is not the case. You have to have a minimum tax liability of $7,500 in order to exercise the full credit and take your liability theoretically down to zero. Of course, other rules and restrictions apply, like the alternative minimum tax, things like that. But again, you can Google your own tax situation there. The next thing you have to contend with is the price cap rule. If you're buying an electric car, it has to be under $55,000. So sorry, no Lucid Airs, no Tesla Model S Plaids. If you're looking for a pickup truck, SUV, or van, that price cap goes up to $80,000. But it still means that every Hummer is out in the cold. The next hurdle you have to jump over is the income testing requirement. You have to have an adjusted gross income under $150,000 filing singly, $225 filing as head of household, and $300 filing jointly in order to qualify for the tax credit. And this is not a sliding scale. Either you're under those amounts and you're in the club, or you're over those amounts and you're out of the club. Once you've checked all the right boxes and filled out the correct forms with the IRS and submitted them with your tax return, you'll notice a tax credit of $7,500 or $3,750. Again, the IRS is not going to just send you a check for this. You have to file your taxes, and you'll see that as a reduction in what you owe the IRS, you'll either get a refund or you'll just pay the IRS a little bit less, depending on your tax situation. But why do we see the two different amounts? That's because of the way the tax credit is structured. There are two critical components to this. Where are the battery minerals from, and where are the battery components made and assembled? The first half of the credit relates to mineral sourcing. Critical minerals like graphite, cobalt, lithium, and nickel must come from either the United States or a country that the U.S. has a free trade agreement with. There are just under 30 countries on the list, and they include countries like Canada, Mexico, Australia, South Korea, etc. The next one is the battery component requirement. This requires that a certain value of the battery pack componentry be manufactured in North America. And this does not include the free trade countries. This is just North America. In order to be eligible, an EV has to meet at least one of these requirements, and it could be either one. But that's why we find, for instance, the GV70 off the list after April 18th, because even though it's assembled in North America, the entire vehicle, which is also a requirement, it doesn't meet either of these battery sourcing or battery value requirements. And these requirements are going to continue to ratchet up. For the mineral sourcing requirements, 40% of the value has to come from the US or the free trade countries, and that's going to ramp all the way up to 80% by 2027. On the battery component side, it doesn't just have to be assembled in North America. 50% of the value of the components has to be from North America, and that ramps up to 90% by 2028. Bear in mind that there's a great deal of investment going on for battery manufacturing in North America, and the situation is very fluid. So it's entirely possible that vehicles could fall off the approved list, or the amounts could change based on updates as far as the mineral sourcing and battery sourcing requirements. Also, manufacturers that aren't on this list right now, like the Genesis GV70, might come back on the list because the vehicle's made here, and if they can sort out some of the sourcing requirements, they could bump up into a tax credit that they don't get starting April 18th. Starting in 2025, there's a new wrinkle. None of the critical battery minerals can be extracted or recycled or processed by an entity of concern, and that would include really anything going on in China or Russia at the moment. The processed component is very critical here because a large percentage of battery minerals are extracted, say in Australia or wherever, but they are processed in China, and that will not be allowed starting January 2025. I don't know about you, but for me, the weirdest thing about these rules is that we still don't know how well these vehicles comply. Does a Chevy Bolt EUV barely squeak it over the wire? It's going to lose its compliance next year, and meanwhile, a Tesla Model Y is fully compliant for the next 3 years already. We just don't know because we don't have that information. And that's something that I was really hoping to see. I was really hoping there would at least be some sort of EPA website we could go to or an update to the window sticker on the vehicle that would say, Tesla Model 3, 50% of the battery components came from X, Y, and Z. 25% came from here, that sort of thing. And we are not getting that level of information. So for all we know, all of these vehicles just barely squeaked it in under the wire. And next year, maybe they'll all be out in the cold. Or maybe some of these vehicles are actually way ahead and their mineral sourcing and battery component sourcing is fantastic and very domestic. We just don't have that level of information. And as a consumer, that's the kind of information I would really love to see. Let me know what you think about that down there in the comments section below. If you haven't already done so, hit that subscribe button so you can be updated on all of our latest videos, including updated tax videos when we get more information from the IRS. It does appear that the IRS and the Treasury are kind of late on exactly how this guidance is working year on year, and there are going to be some pretty substantial changes coming up soon, especially with the new sourcing requirements starting in 2025. I'll see all of you next week.